From an investing perspective, if there could be one thing for which 2025 will be remembered, it would be mega rally in gold and silver. In 2025, gold delivered about 72% returns and silver a fantastic 125% returns. A big question is if gold and silver can continue their mega bull run. But why just gold and silver? After a lackluster 2025, can equity markets bounce back in 2026? If yes, which market cap? Large, mid or small cap will do well. More broadly, how would the economy itself do in 2026? And what investment should you keep on your radar? The answers to all these questions are crucial for you to stay ahead with your investments in the new year. And in this video, we'll try to answer these questions. Hello and welcome to ET Money's YouTube channel, and in this video we will discuss the top investing trends for 2026. Our discussion will span across asset classes, so it will be useful to you no matter what your investment preference is. Now this video belongs to our playlist on market trends. To watch more such videos, you can explore it. The link is in the description. Okay, let's start with gold and silver and whether they can continue their bull run in 2026. In 2025, gold and silver returned about 72% and 125%, outperforming all other asset classes by a wide margin. It would not be wrong to call 2025 the year of gold and silver. But can this rally sustain, or have gold and silver prices already run their course? To figure it out if the rally in gold and silver has legs, let's assess the drivers of gold and silver. We discussed them in detail in our earlier videos, so you can watch them to gain better understanding of the drivers. Here, we will quickly do a status check of these drivers. Let's first check the 4 drivers of gold prices. First is the classic demand and supply scenario. Now, as per the World Gold Council data, for the last 4 quarters as of September 2025, the total demand for gold stood at 4,955 tons. Against this demand, the supply stood at about 5,002 tons. So, supply and demand are well matched. The next factor is US interest rates, to which gold prices have an inverse relationship. Now in 2025, the US Fed cut interest rates 3 times in September, October and December. This helped gold prices. However, the Fed has turned cautious and signaled a pause in rate cuts in 2026. It has projected just one rate cut in 2026. But intense pressure from President Trump to lower rates further can work in gold's favor. That's something only time can tell. As of now, this driver appears to be rather neutral. The next driver of gold prices is the movement of the US dollar, to which gold has an inverse relation. Now, over the last 1 year, the dollar index has fallen, which suggests the dollar has weakened against a basket of other currencies. This has favored gold prices. Now, given President Trump's trade tussles with other nations and volatile politics, it's likely that the dollar index will resume its decline, thus favoring gold prices. The last driver of gold is geopolitics. Gold favors from an uncertain geopolitical scenario as trust in the global financial system weakens. Trump tariffs, Russia-Ukraine war, and Middle East conflicts can all keep gold in demand over the next year too. So geopolitics favor gold's upward move. Overall, gold drivers have not yet shown a weakness in gold prices. It's likely that gold will move sideways after a brief correction, if any, or resume its upward march perhaps with a lower magnitude of returns. Now what about silver? The 4 drivers of gold apply to silver as well. However, unlike gold, silver demand outstrips its supply. Silver is also an industrial metal and hence it has a direct correlation with economic activity. Now, in its October 2025 economic outlook, the IMF predicted a slowdown in global growth from 3.2% in 2025 to 3.1% in 2026. Now, that's not good news for silver. But silver has seen increased demand for semiconductors, data centers, clean energy, EVs and other new age technologies. As such, silver is an important ingredient of new age tech, and as this space flourishes, so will silver prices. Silver also have a positive correlation with the movement of copper prices and gold prices. Gold prices are going up and so are copper prices. Overall, the scenario doesn't appear to be negative for silver either. That suggests an extended bull run or sideways move or a brief sentiment-driven correction, if any. Now, as compared to gold, the demand for silver from new age tech is an important differentiator that can give silver an edge over gold. This brings us to the next trend. But before that, let me request you to subscribe to this channel if you aren't already a subscriber. And don't forget to press the bell icon so you never miss a video from us. In 2025, major equity indices delivered a subdued performance. The BSE 100 generated about 9%, BSE 150 mid-cap about 4%, BSE 500 about 6%, and BSE 250 small-cap lost about 5%. Now, will this return picture improve in 2026? For that, let's take a look at the annual returns of BSE 500 index over the last 20 years. If we filter out those years from this history where the index gives single digit or negative returns and then compare those returns with the returns next year, an interesting picture emerges. Except for two occasions, the returns were in double digits and even upwards of 20% in most cases. Now this happens because after a period of subdued returns, markets tend to become the storehouse of value and this value gets unlocked. By this metric, it appears that markets may rebound in 2026. But if you take a look at the current valuations of major indices in terms of their price to book or PB ratio and compare them with their 5-year medians, all indices are currently at a premium. The mid-cap index has the highest premium of 53% and the large-cap BSE 100 has the least premium of 20.2%. This makes large caps the most favored among the three market caps. But overall, the market may consolidate further in 2026 or even correct. Now, if we map the median PB of the market for the years when it didn't do well but gave good returns the next year, the PB range of 2.34 to 3.85 emerges as a sweet spot for the BSE 500. Now, since the current PB of BSE 500 is much higher at 4.39, that also makes the case for a consolidation or correction. But do know that market movements are not as much as function of historic valuations as future potential. And this means checking the economic picture of the year ahead, which is the next point. In Q2 FY26 or the third quarter of calendar year 2025, the Indian economy grew by 8.2%. That's the fourth consecutive rise since the third calendar quarter in 2024. Multiple forecasts suggest that India is going to do well in 2026. Now, consumer price inflation rates are trended lower, and so are interest rates. Crude prices are also very much in control. However, a falling rupee can prove to be a cause for concern. Overall, the economic picture appears to be robust and hence can boost asset prices. But India's growth story is far more nuanced than it appears in these headline numbers. To know the real picture of India's growth not just in 2026 but over the next decade, you can watch our video on this topic. As usual, the link is in the description. Now this brings us to the last part of this video, investments you should keep an eye in 2026. Among two mutual funds, two fund categories did well in 2025, multi-asset allocation funds and credit risk funds. While multi-asset allocation funds delivered an average return of about 17%, credit risk funds generated 10%. Now what worked for these funds? Allocations to gold and silver likely worked in the favor of multi-asset allocation funds. So did a comparatively lower allocation to equities than their pure equity counterparts. For instance, the top 5 funds in this category had an average allocation of 14% to commodities or gold and silver in November this year. On the other hand, credit risk funds benefited from lower interest rates, no major defaults, enhanced credit sentiment, and lessons learned from the credit crisis of 2018. However, please note that these funds are not suitable for all, as they carry a high risk due to their high exposure to lower rated bonds. You could consider investing in them only if you understand the risk involved and can tolerate high volatility. Most debt fund investors can do without credit risk funds. The second investment that can be on your radar is REITs or real estate investment trusts. REITs invest in commercial properties such as offices, malls, IT parks, hotels, etc. They trade just like stocks and can be bought and sold via trading and demat account. Now, REITs distribute the majority of their cash flows to their stockholders via distributions, so they generate income along with capital appreciation. Recently in November, REITs have been accorded equity status by the SEBI. From January 1st, 2026, mutual funds can consider them as part of their equity allocations. This can result in higher inflows into REITs, which can drive their prices higher. Now, in 2025, REITs have performed quite well, with their returns ranging from 14% to 29%. And that's in addition to a distribution yields of 5 to 6%. Now, as per a report by ICRA, office absorption in 6 major cities is going to hit a record high in FY26. This will also benefit REITs. If you'd like to understand REITs in great detail, you can check out our playlist on REITs and InvITs. The link is in the description. Finally, if you're interested in the stock sector and themes for 2026, we've already covered them in our earlier videos. For promising sectors and stock, you can watch our Q2 result update. For emerging industries with favorite tailwinds, you can watch our video on 3 high growth industries and listen to the podcast featuring Sunil Singhania. And finally, for long-term themes, you can watch our related video that discusses these 3 such themes. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.